Good morning, traders and investors around the world. Welcome to the final edition of Pre-Market Prep with Stock Odds for this wild week. S&P 500 index futures went from major green to red, down three handles at 54 and a quarter, just hanging above the intraday low. Pre-market low, which I hope we don't see, is down at 42.32. Crude, that's up $2 at well, I got the May up there. Let me get the April up there because it hasn't expired yet. Well, the that's up too. That's up 230 at 108.32. Gold taking a hit, down 21.60 at 1978.80. Silver in the red by 15 cents, 26.11. Bitcoin in the red by 585, 39,030. Ethereum in the red too by $40 at 25.78 and a half. Going to stop the screen share. And Rob, how reliable are your indicators?
Oh, pretty reliable. I mean, there are some moving parts, but it's not a matter of them being,
timely. How timely are they?
Well, they're actually ahead of time. They're ahead of time. We'll talk about that in a minute.
Okay.
So let me ask you a question. Oh, you've heard the song "I Won't Get Fooled Again," right?
Oh, of course.
I mean, you play it all day.
One of my favorite bands of all time. One of my favorite bands of all time. The Who.
Well, you play it all day probably when the algos run amok with your trading plans. But anyway, so let me get this straight. Someone who says, "No, I know it looks bad, but I'm not actually going to invade Ukraine," and then obviously does. So today you're going to listen to him say, "Hey, we're getting pretty close to peace talks."
Hit me aside ahead. Were you
listening? Come on, people. Come on. Okay. So let's share the screen here for a minute.
Okay.
I mean, is that too shock jockey? So we obviously had that premium from some positive whatever comments, and we started to taper off. So remember, we've had this discussion about premium and discount and the opportunities that come. Sometimes the market will gap up and continue up, but a lot of times that's after a multi-session down or some real catalyst that changes something. There are specific days and context to the market gapping up and continuing to go up. Okay, regardless of whether it went up at the open after already being up in the overnight session, there are groups that will go up and there are groups that will go down. One of the great trades is on a risk on day. If you actually have a risk on day, to short stuff that gets lifted with that pre-market and sort of opening energy and opening buzz, but are really going to get sold because there's a rotation going on out of that stuff into other stuff. Does that make sense, Joel?
A lot of sense. Yep.
Okay, so example, we're gapping up huge on a risk on type of day. Utilities is also jumping. Hey, I'll short that any day, right? Boom. Because it's going to, have that opportunity, that gift, but there's going to be rotation out of that boring stuff into riskier assets. Okay. So there's always some groups that are going to be more sympathetic to the movement ahead of time in the market. And there's some that are going to, take that opportunity in reverse. Okay, so a good opportunity to take profit, a good opportunity to sell, a good opportunity to sell short, whatever your agenda is. Now, we've talked about it before when it's sloping down after an event. And it could have been any type of announcement. It could be inflation data, it could be whatever it is, right? So something caused it to move, and now it's and the question is, and I brought this up many times. Okay, we know what the catalyst was now, or it might be multi-factor, but is there still gas in the tank? So you've got the engine of the catalyst, but is there still gas in the tank, or is it starting to sputter and run on fumes? Okay, that's what you have to ask about any pre-market move. What was the reason? Is it still got gas in the tank? So the beautiful thing about this is that you can have your odds for the day ahead of time. I'll give you an example with, if it's a risk on day, then yes, some discretionary names will move with it and some will probably fade after the gap. But how do you know which it's going to be? Well, that's kind of where StockOdds comes in. So you can take, I put in Nike, for example. The consumer discretionary should be pretty good for a risk on day, you would think, except that we were risk on and you could see it starting to dissipate. So if I can sell any discretionary type names, up there at a premium at the open, I'm a little bit buffered on the risk side because it's already up and that's where I'm shorting. Just like if it's already down and you were buying. So think about that from that perspective. Yes, it might be looking like a risk on day, but we're qualifying whether there's really a full tank of gas there, right? That's really key to think about. And if it's starting to sputter and yet I can sell discretionary names at a premium, I may have some real opportunity. So this is an example, Nike here. You can see, you can just put in a symbol and you can go through various indicators. This is move open to close with output open to close. So I'm taking what happened yesterday from open to close, and I'm taking an indicator and seeing what the subsequent performance will be after that move. So it had a move. What do I expect the next day from open to close? So this says odds are only 38.8 of an up day after that move yesterday. Average performance is negative 0.4%. Okay, Sharpe ratio is negative. So this looks attractive from a short perspective. Okay, so if it already looks attractive from a short from the open and you're getting a gap open that is starting to, even prior to that, starting to sputter a little bit, you could really have a good day trading that. Let's just check it on the percent, or let's check it on RSI and see what it says. 44 odds, minus 0.17 performance, and minus 0.12 Sharpe. And let's check it on the percent B. And again, 47 odds, so less than 50, average performance negative 0.24, and Sharpe negative 0.16. So on what it did yesterday, how it hit the RSI yesterday, and how it hit the standard deviation or percent B, which is proximity to Bollinger Band, all three of those said it's a short from the open to close today. Okay, now that's some data points that are just speaking about the opportunity. But if the market was opening down huge, your opportunity would be somewhat impacted because your open is so low. But if the market's gapping up, then your starting point is enhanced.
Getting a head start.
Right. So you actually have a bit of impact to your overall stats based on your starting position. No different than playing poker. What's your position? How are you related to the button? You know, on a track and field. I mean, there are lanes that are more favorable than other lanes, right? They just are. So it could be psychological, but you know, it's your starting position. So today's a good time to think about starting position. So what I want to ask you guys is, if you take a look at your indicators, let's put in Nike. The reason this came up, the reason this topic came up, I was talking to a trader that all his buys were firing at the open today. For the first 5 or 10 minutes, they were all flashing buy, 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 buy. And if you were looking at being short, so so on this stock, for example, he would be flashing buy, 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 buy. Why is that? So many indicators are looking at the change in price, you know, the relative strength side of it. They're looking at, oh, it's up, therefore it's more indicative of a buy. And so you might even get yourself buying initially, only to be maybe stopped out. And by the time you reverse, it's heading back. So you get whipsawed. I can see this clearly here, how this might have happened to someone. Buy it out of the gate. Oh, it's now doing an open crossover move and going to get stopped out. And oh, I think I should go short now. It's starting to break. You know, it looks like it'll, well, they actually go, it looks like it'll go through the previous day's close, and they get short, and then it fails and they get whipsawed, and finally they just throw the towel in and take Nike off their screen altogether. Whereas from a statistical perspective, you'd be looking at, okay, Nike is indicated as a potential short. It's in consumer discretionary. That kind of fits with the landscape today of things opening up, but yet sputtering because of the reason that we actually had that move. Like I'm going to believe a madman. Okay, you know what I mean? So
Yep. Eric says you guys have snapped me out of the habit of chasing, especially in this market.
oh, I love to hear that. No, honestly, that's it, you know, it's by the time, see, here's the problem. Even if we went to the Qs and it was like, okay, you know, it's opening up, everything's looking really good today, looks like risk on, and so you start to buy. Not only will you face sort of getting stopped out, by time you reverse, you've given up a tremendous amount of distance, right? That could have been utilized by you already having that strategic position, you know, being short. And so today was, you know, clearly that opportunity. We were talking about SQQ. I got to show you this. So if you don't want to short and you want to look at buying a long that is the inverse, you can see the same thing on SQQ before the market. It's tracking up, as obviously the Qs were tracking down. And then right out of the gate, you know, look at, if you want to play relative strength, or you want to play pullbacks to, you know, a moving average or to a trend line, you had perfect opportunity with the inverse. So just think about these things in terms of how you can improve, because I find the indicators across the board, not only are they late in real time because they have to calculate the previous price and volume and other types of things. So they're kind of, that's why we call them lagging indicators. And by the time they tell you to buy, might be the time to be actually selling it, right? Yeah, any comments there, Joel?
No, I just setting up the pre-tax. I think the most important thing that people should take away from this is, you know, it's so easy to get caught up in the emotion, and it's not always good just to be an automatic contrarian, right? But what I think what I'm learning too from stock odds is, you know, quantifying, you know, that being the contrarian, right? And you know what the expectations are. So tough market. You know, I'm glad that you know, you're giving some people some guidance here. Let me see if we got any questions here. Let's see here. So Jamie Morrow says, so my head is spinning. Risk on, but it's a fake risk on. So we short discretionaries,
Well,
not look to buy them.
that's a
He
good,
meant staples.
it's really a good question because you have to go back to, okay, let me give you an example. Came in one day and we had bombings in a London subway. Our market was opening down about 30 points below fair value potentially. So my first question is, okay, we have an incident somewhere in the world, it's terrorism related, and that's not good. But what does that really have to do with the US listed stocks today? And in fact, if there is a concern, a posture to, defensive things, what can I buy at the discount that the market's opening at? So it would be different to buy, a cruise line potentially, or an airline stock that morning. But wouldn't it be better to buy maybe, a consumer staple, a utility, defense contractor, if it was happening to also being opened down sympathetically to the market? So it's called the sympathy trade. Things move either as a direct result of being hit with the news or hit with the macro, or they're sympathetic to something. And if they're sympathetic, how strong is that bond? Is it even related? In this case, the market move, you can see the headlines coming through constantly, the pre-market and after even the open, and that is market up on Putin's positive comments or whatever. Okay, the instant that I saw how the market responded, I said, the song just came, it just, I won't get fooled again. I mean, it's just like, it's like, so now you're going to believe somebody that's not believable. Okay, well, have fun, knock yourself out. So
Okay.
yeah,
I don't know if I hope that that answered your question, Jamie.
well, the question is this: yes, the market looks like a risk on environment because everything's indicated up and it moved significantly. But then the question is, what has happened since the news? Okay, you see there's a change. There's a change, but we're still opening up. Okay, but what do you want to be long and what do you want to be short? If you went long, a high PE, high debt type company that was gapping up, you might be in for a surprise. Rather, if you shorted a consumer discretionary stock, like I was showing you with Nike, you're already shorting it at a premium, so you're buffered in that. So when the market's opening down, you have to think about what's the best things to buy. When the market's gapping up, what's the best things to sell? If there's any risk of it changing from a risk on day to a risk off day, you have to factor that a little bit, right?
Did you say short discretionaries or staples on today's early action? Was his question.
Oh, well, I mean, there's a mix. There's some great low PE stuff that is consumer staples that is off as well.
Okay.
Right. So it, it's not like you should have just automatically shorted discretionary and bought consumer staples. That's not what I'm saying. You can go to StockOdds and you can select from all kinds of groups, what might be the best. I'm just saying that when it looks like a risk on market, you have to ask the question, is this sustainable? Is there a potential of reversing?
One quick question here from Eric, and then we're going to wrap it up. Did you have any second thoughts about shorting at the open? We did open higher from yesterday's close, but we also leaked a good amount from the pre-market high by the time we opened.
Well, that's what I'm saying. We pulled back from the pre-market high.
Right. So
right? So the thing is, sometimes that provides an opportunity to go long. Yes, we've talked about that. So good comment. And sometimes it's an indication that what caused the move is suspicious or fading or
okay.
running out of gas, running out of steam. So there's those two it's a dichotomy, right? The market was up this high. Watch my hands for a sec. It was up this high, pulled back, could be a buying opportunity.
Correct.
Okay. Market's up this high, pulled back. It's telling you something. It's running out of gas. So which is it? Well, some of your other indicators can help. Like, for example, what's the VIX doing? What's, even the pre-market indication on the breadth of the market, the advancers over decliners. You can get that information for free from the UK's charts. If you want, you can see what the breadth of the market is doing pre-market, the TRIN and the ADD. And when you're up at 1100 already pre-market, that's kind of in that area of they've been paying too much. They've been chasing too much here already pre-market.
Gotcha. Okay.
Like
All right.
if something's like minus 200 to minus or positive 200, positive 300, that's kind of like, hey, there's plenty of room. But when we get like 1100, 1200 or anything above that,
where can you go?
they've been buying too much pre-market.
Okay.
Opportunity to short. Okay.
All right. Rob, I want you to stay on for a second after we end pre-market prep with stock odds, wrapping things up here on this volatile week. Everyone have a good weekend. Back with you on Monday.
Why don't you just call me on Skype or something?